everyone. Welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner and owner of Elevation Financial. I'm on the web at elevationfinancial.com. Thanks for joining me today. As always, I'm really glad you're here. So today we are talking target date funds. You're maybe wondering, should I invest in a target date fund? What are the pros and cons? We're going to cover those pros and cons today. So let's jump into it. So if you're saving for retirement through a 401k plan or something similar like a 403b, chances are you've seen target date funds, also called TDFs, listed as an investment option. So if I say TDF throughout this episode, that is short for target date fund. So just be aware they're interchangeable. It's an acronym. So you might be invested in a target date fund right now. Maybe that's what you're already invested in at work. They're convenient, they're popular, and they're kind of designed to do the hard work for you. But does that mean a target date fund is the best choice for your financial future? Let's unpack what TDFs are, how they work, what the latest research says about them, and whether they really live up to the promise. So first off, what is a target date fund? A target date fund is a type of mutual fund that automatically adjusts its investment mix based on your projected retirement date. If you plan to retire in 2060, for example, you'd choose a 2060 target date fund. These funds typically start with a higher allocation to stocks when you're younger and gradually shift toward bonds and other lower risk assets as you near retirement. So this changes over time, and this is known as the glide path. Target date funds are often the default investment option in 401k plans, especially since the Pension Protection Act of 2006 allowed them to be used as something called a qualified default investment alternative. So today, about 70% of new 401k contributions are going into TDFs, and they represent about a half of all retirement account holdings in the US right now. And that makes them a really huge part of the retirement ecosystem. So it's important to understand them and how they work. So why do people like target date funds? Why are they popular? There's a really good reason why TDFs are so popular. It's because they simplify investing. For one thing, you get automatic diversification. It just kind of puts it in a basket that's well diversified in general. You don't have to think about rebalancing. It just kind of happens automatically. And you get professionally designed asset allocation that adjusts over time automatically for you. So for many investors, especially people who don't want to manage their portfolio actively, that's a really big win. It's really attractive. Research shows that people are less likely to panic and sell during downturns if they're in a TDF compared to building their own portfolio. So if you're wondering, is a target date fund a good fit for someone like me who just wants a hands-off way to save for retirement? The answer could be yes, but that's only part of the story. So let's dig in a little bit deeper. So first thing, there are some hidden differences between target date funds. There's a common misconception that all TDFs are basically the same, but in reality, they can vary widely depending on the fund company. Each provider creates its own glide path and chooses its own mix of investments. Some just use a handful of funds inside the TDF, while others use more, dozens even. Some funds hold mostly passive index funds, and others can rely heavily on actively managed funds. And this can create a pretty big difference in performance between target date funds. There's a 2023 study by Professor David C. Brown with a co-author Sean Davies, and they analyzed the performance of TDFs by comparing each fund's glide path to a custom benchmark made of low-cost index funds. And the research showed that most target date funds underperform compared to the simple passive alternative. In fact, on average, target date funds lagged by about 1% per year. And the two main culprits that led to this are one, fees, roughly 55 basis points or 0.55% of the underperformance came from higher fees, including both the fund level fees and the underlying investment fees. Also, the second factor was poor active management. Another 45 basis points or 0.45% came from active managers failing to beat their benchmarks. So another factor adding on to this is that some TDFs are actively deviating from their stated glide paths. Fund managers will often make tactical asset allocation decisions, shifting investments based on short-term market outlooks. So according to the findings in this study, the tactical shifts result in about 10 basis points of additional underperformance annually. Again, not a lot, but still negative, still something to be aware of. So additionally, performance can vary widely between target date fund providers. So depending on the provider, your experience in a target date fund could be different. At one point, there was a 23% monthly return difference between the best and the worst performing TDFs of the same class. Basically, there's an extreme case, but over longer periods, performance dispersion of 1 to 3% per year was not uncommon. So there's a spectrum of deviation there, but in some cases, it's pretty large. So in recent years, some providers outperformed their benchmarks by over 1%. So some did outperform. Some providers lagged their benchmarks by a similar margin, and some have previously underperformed. They've improved and now slightly outperformed benchmarks in some TDF series. So a lot of variety there. So if you're invested in a TDF through your workplace plan, you're probably stuck with whatever they provide. You don't get to choose between providers. They decide for you. Most plans offer one series, and that's it. And that's why plan sponsors and HR departments really need to understand these differences and be willing to make a change if the chosen fund is not ideal. So let's talk about the glide path. Is the glide path optimal? There's also a debate over whether the typical glide path, which means more bonds over time, is actually optimal. There is some research, including a paper by Professor Scott Cederberg, suggesting that an all equity portfolio, even in retirement, might be a better long-term strategy. And that really runs counter to the traditional idea of de-risking with aging, going more toward bonds as you get older. That said, though, behavioral concerns do matter. So not every investor can stomach the volatility of an all stock portfolio. That's pretty volatile. So during a market crash, even a well-designed portfolio won't help you if you panic and you sell at the bottom. So while the math might favor higher equity exposure, the best portfolio is the one you can actually stick with. So what should you do if you're in a target date fund? If you're already in a target date fund, doesn't mean you have to just bail right away, but it does mean you should look a little deeper. One, identify the target date fund provider who's managing it. Look under the hood. Is the fund mostly passive or active? What are the fees? Three, assess the performance. There are tools like glidepathfinancial.com that let you compare your fund to a benchmark and see how it's doing. And look at the glide path. Does the asset allocation make sense for your age, your risk tolerance, and your financial goals? So if you're comfortable with the fund's performance, the fees, the glide path, and you're the kind of person that really appreciates simplicity, staying in a target date fund could make sense. But if you're more hands-on, or if you see signs of underperformance, you might consider building your own portfolio with low-cost index funds, or even work with an advisor who can tailor the strategy for you. A big issue I have with target date funds is really going back to the fact that target date funds don't know the whole story. It's one of the biggest limitations of target date funds. They're built around a single data point, which is one thing, your expected retirement year. That's it. They don't know anything else about you, your income, your savings rate, your other investment accounts, whether you're married, whether you've got a pension, what your goals are, what kind of lifestyle you want in retirement. TDFs operate under a one-size-fits-all approach, which means they can't really provide a personalized investment strategy. And that lack of context can sometimes lead to suboptimal outcomes. For example, some target date funds begin shifting to more conservative investments, such as bonds or cash equivalents, far too early for your situation. If you're still in your peak earning years and you plan to work for another 10 or 15 years, moving away from growth-oriented investments too soon can really suppress those long-term returns. It's not uncommon for someone in their early 50s still saving aggressively and years away from retirement to find their target date fund already reducing stock exposure. And that might help limit volatility, but it also limits growth potential at a time when they may still need to be building wealth. If you have other sources of guaranteed income, or you're just comfortable with market risk, you might be able to take more risk than a target date fund would assume. But the fund doesn't know that. It just sees the calendar. And that's where a more holistic financial plan makes a difference. A plan that looks at your entire financial picture, which includes cash flow, taxes, other investments, and your long-term goals. And that's what can set the appropriate asset allocation for you, not just based on your birth year. So target date funds do offer simplicity, but they don't offer personalization. And in some cases, that means potentially leaving some money on the table. So what's the bottom line? Are target date funds worth it? As with most things in personal finance, target date funds are not a one size fits all. They can make sense in many situations, but they might be suboptimal in other situations. So as always, look at the pros and cons before you make a decision. So the pros of target date funds: they're simple and they're automatic. It's a professionally managed glide path. It helps avoid behavioral mistakes. It's a great option for hands-off investors. If you just don't want to mess with it, it's better than nothing. It's better than sitting in cash, so it's definitely not the worst thing you can do. What about the cons? What are some downsides? The performance varies widely between providers. There's not a lot of standardization between performance. Many funds underperform due to high fees and potentially poor active management. Also, the glide paths aren't standardized and they aren't always optimal. Lack of transparency. You can't always understand what's going on inside the TDF. And then finally, it doesn't take into account any other facts about your financial life. So target date funds have improved retirement outcomes for millions of Americans. Don't get me wrong. It's been a good thing, but they're not all created equal and they're not always the best choice for everyone. So do a little homework, understand what you're buying, and make sure it aligns with your needs, your risk tolerance, and especially your specific financial life. All right. With that, as always, if you have questions about this or anything else, feel free to reach out. I'm easy to find. I'm at elevationfinancial.com. You can reach me on social media or through my website, or even better, if you want to chat in real time, get a little bit of questions answered, some education, just some stuff to talk over, feel free to book a free consultation on my website. And again, that's elevationfinancial.com. All right. Thanks for joining me today. Have a great day. See you next time.